Zillow just confirmed what many of us have been feeling in our wallets. For 6 straight months, US home prices have been falling. If you own a home, this means your net worth on paper is shrinking. If you're trying to buy, you're probably asking yourself, is this the opportunity I've been waiting for, or is it a trap? Because once you see what the data is actually showing, it explains why buyers, sellers, and even builders suddenly feel stuck. According to Zillow's brand new report, this isn't just a winter slowdown, it's a real, sustained pattern. The party seems to be over, the bidding wars have vanished, and what's left is a housing market that feels like it's holding its breath. For the last few years, the housing market felt like a one-way street, where prices only went up. Bidding wars and waived inspections became the norm. If you were a homeowner, you watched your wealth explode. If you were a buyer, you were pushed to the absolute edge of what you could afford. Well, it looks like that reality is finally starting to crack. Today, we're going to walk through exactly what's happening so you can make smarter decisions. First, we'll break down the new numbers straight from Zillow's January 2026 report. Second, we'll look at why this is happening, because it's about more than just prices. Third, we'll cover what this new reality means for you, depending on whether you're a homeowner, a buyer, or a seller. And finally, I'll share how I would personally be thinking about navigating this market to protect myself and find opportunities. This is more than just data. It's a flashing light on the economy's dashboard. So let's get into it. All right, let's get right to the data, because the numbers tell the real story. The headline from Zillow's latest report is centered on their Home Value Index, which is basically the pulse of the American housing market. In January 2026, the typical US home was valued at around $359,000. But here's the number that really matters. That's a 0.4% drop from the month before. Now, a 0.4% drop might not sound like an earthquake, and it's tempting to shrug that off. But here's the part most people miss. The real story is the pattern. January marks the 6th month in a row that values have gone down. Since the market peaked back in July 2025, home values have consistently ticked down month after month. In simple terms, this isn't a blip, it's a trend. That consistency is what separates a minor cooldown from the start of a real market correction. Quick reality check. We actually saw a similar pattern of monthly drops between August 2024 and February 2025, when the market was in shock from soaring interest rates. But this time feels a little different. The market has had time to digest higher rates, yet the downward pressure is still here. But here's where we get a bit of a plot twist. If you zoom out and look at the year-over-year numbers, home values are actually still up by a tiny 0.2%. So how can prices be up for the year, but down for 6 months straight? Think of it like a car that floored it up a hill for the first half of the year, and has spent the last 6 months slowly rolling backward down the other side. All of the year's gains happened early on, and the second half of the year was spent giving them back. So what does Zillow itself say about this? Their chief economist called it a gradual improvement toward a more balanced market. And while winter weather always plays a role, it doesn't explain a 6-month nationwide decline. This is about a fundamental shift in supply and demand. The power has decisively shifted away from sellers. The one piece of good news in the report, especially for buyers, is that the typical monthly mortgage payment is now 8.4% cheaper than it was at its peak. That's thanks to this small dip in prices and mortgage rates easing off their highs. This is the market's natural way of trying to find a bottom. But the big question is it enough to stop the slide, or is it just a small cushion on a much longer fall? Falling prices are just one piece of the puzzle. To really get the full picture, you have to look at how many deals are actually getting done. This is where it gets interesting. The National Association of Realtors tracks pending home sales. These are homes where a contract is signed, but the deal hasn't closed yet. It's one of the best crystal balls we have for the market's direction. Their latest report showed a shocking slowdown. In late 2025, pending sales fell by 9.3% in a single month. To put that in perspective, that wasn't a small dip. It was the biggest drop since the 2020 lockdowns. Overall, total home sales in 2025 hit their slowest pace since 1995. Here's what that really means. Buyers are disappearing from the market, and fewer buyers doesn't just slow sales. It usually leads to more price negotiation and downward pressure over time. The pool of people who are both willing and able to buy a home has shrunk, and it's causing the whole system to jam up. This is confirmed by another key piece of data, this time from the brokerage Redfin. Their analysis shows the typical home that sold in January spent 64 days on the market. That's the longest homes have sat for sale in 6 years. Think about that for a second. A house that might have sparked a bidding war and sold in a single weekend 2 years ago is now sitting for over 2 months. The fear of missing out that drove buyers into a frenzy has been replaced by a new fear, the fear of overpaying. On the ground, this means we're also seeing a spike in contract cancellations as buyers get cold feet. They're using the inspection period to renegotiate or simply walking away. This creates a painful cycle for sellers, who suddenly find themselves back on the market, competing with more homes for fewer buyers. And let's talk about inventory. For years, the story was, there are no homes for sale. That story is over. Zillow's report shows there are now 1.11 million homes for sale, up 6% from a year ago. For the first time in a long time, buyers have something they haven't had, a choice. They can be picky. They can wait. They can negotiate. The power has completely flipped. So where is this slowdown hitting the hardest? Right where you'd expect. The markets that flew closest to the sun during the pandemic boom. For years, the darlings of the housing market were cities in Florida, Texas, and Arizona. Prices there exploded at a pace that was completely disconnected from local wages. Now, those same markets are the first to feel the pullback. Zillow's own data shows major price drops in cities that were once the hottest in the country. Let's take Orlando, Florida. Today, home values there have fallen 4% year over year. What was once a symbol of growth is now a poster child for this reversal. And for people who bought near the peak thinking prices would keep rising, this is where patience and long-term planning start to matter. And then there's Texas. Cities like Dallas and Houston saw some of the most frantic buying. Now, Dallas has seen a year-over-year decline of 3.9%. The trend is clear. The markets that saw the most frantic growth are now seeing the most significant reversal. In fact, Redfin's data shows other Sunbelt markets with even steeper drops, like Fort Lauderdale's median sale price falling 4.4% year over year. Let me show you why this matters. It's a perfect storm. The rush to relocate has calmed down, and more importantly, inventory is surging. Builders went into overdrive planning new communities, and all that new supply is hitting the market at the exact moment demand is collapsing. It's a classic oversupply problem. But if you want to know where this might be headed, look at the forecasts. Realtor.com released a prediction that should make anyone in Florida pay close attention. They predict that in 2026, 7 of the state's 8 largest cities will see prices fall. And for the Cape Coral Fort Lauderdale area, they are forecasting a stunning 10.2% price drop. Let me repeat that. A major real estate authority is officially forecasting double-digit price drops for some of these specific overheated markets. This is the unthinkable part of the title. We are now seeing credible forecasts for price drops in specific areas on a scale we haven't seen since 2008. If you like videos that break down the data without hype or panic, you'll probably like the rest of the channel. Subscribe if you want to keep following these housing shifts. My goal is to give you the clearest information possible so you can make smart decisions. No hype, just the numbers and what they mean. So, prices are falling, sales are slowing, and a correction is underway. The big question is, where does this end? Is this a healthy rebalancing, or is it the edge of a 2008-style catastrophe? First, let's go back to Zillow. Their official forecast for 2026 is for national home values to actually rise by a modest 1.9%. They see a path to a balanced market, not a crash. Next up is Redfin. They are forecasting an even smaller 1% rise for 2026. Their view is that this isn't a quick crash and recover event. Instead, they see a multi-year great housing reset, where wages slowly grow faster than home prices, gradually fixing the affordability crisis over time. No crash, but no quick recovery either, just a long, slow grind. Then there's Realtor.com. They predict a small 2.2% increase in home prices for 2026, but with a huge catch. They expect inflation to rise faster than home prices. This means that even if the sticker price of your house goes up, its real, inflation adjusted, value will actually fall. It's a stealth correction. It's like getting a 2% raise when inflation is at 3%. Your paycheck is bigger, but you can buy less with it. The same thing could happen to your home equity. So what should we make of this? There's a range of opinions, but nearly every mainstream expert agrees on one thing. This is not a repeat of 2008. The reason is simple. The financial system is in a completely different state. The 2008 crash was caused by a banking crisis fueled by toxic loans. Today, lending standards have been much stricter. We are not seeing a wave of forced selling from foreclosures. This is a correction driven by affordability and interest rates, not a total failure of the financial system. It's a correction, not a catastrophe. All this data is interesting, but what does it mean for your decisions? This isn't financial advice, but here is how I would be thinking about this situation. If I were a homeowner, the era of easy equity gains is over. Your home value isn't a stock that you need to check every day. If you have a low fixed rate mortgage and you love your home, the best thing you can do is relax and ignore the noise. Your payment is fixed and affordable, and that's the most important thing. However, if I were planning to use my home equity like an ATM for a big renovation, I'd hit pause. That Zillow estimate you see today might not be there in 6 months. That equity buffer is getting smaller. If I were a potential buyer, this is the best news you've had in years. The power is shifting to your side. You have more choices, more time, and more negotiating power. The days of waiving inspections are over. My strategy would be to be patient and picky. Make reasonable offers, but demand contingencies for inspections and financing. Don't be afraid to ask for seller concessions to help buy down your interest rate. Affordability is still a huge challenge, but the door is finally starting to crack open. If I were a potential seller, you have to face the new reality. You have missed the absolute peak. If I were selling in 2026, my entire strategy would be based on pricing my home correctly from day one. Overpricing your home in this market is a recipe for disaster. It will just sit there and get stale while the market falls further. I would be prepared for the home to take longer to sell, maybe 2 or 3 months, and I would expect to negotiate. Selling a home is hard work again. The data from Zillow, NAR, and Redfin all points to one clear conclusion. The great American housing boom is over. The 6-month decline in home values isn't just a blip, it's a major market correction. While this isn't a 2008 style crash, it is a painful adjustment, especially for those Sunbelt markets that were fueled by unsustainable hype. We are now in a world where sales have slowed, inventory is rising, and buyers are finally back in the driver's seat. The road ahead looks like a slow grind back toward a more balanced, normal market. The unthinkable thing happening isn't a crash tomorrow, it's that the easy money is gone, and the housing market is no longer an engine for effortless wealth. Now I want to hear from you. What are you seeing in your local market? Are prices coming down? Let us know in the comments below. This is one of those topics that's easier to explain by walking through it together. If you found this breakdown helpful, one of the best ways to support the channel right now is to use the YouTube hype feature next to the like button. It helps us reach more people without using crazy clickbait titles. Thanks for watching.